Hey Radio Rothbard fans, the Mises Institute has a new free book for you. Dr. Guido Holzmann's How Inflation Destroys Civilization. Learn how inflation isn't only making us poorer, it's harming our culture, mental well-being, and the moral foundations of civilization itself. Get your free copy today at Mises.org/RothPodFree.
Hey guys, this is Tho Bishop with Radio Rothbard, and if you're listening to the show, you're no doubt familiar with Human Action, Ludwig von Mises' masterpiece. This is the 75th anniversary of its publication, and in honor of that, we are holding a very special event on May 16th through the 18th, a conference dedicated to this very important book. We're going to have scholars from all around the world coming in, including Bob Murphy, Guido Holzmann, Joe Salerno, Tom DeLorenzo, a whole list of all-star Austrian scholars. Now, as a Radio Rothbard listener, we've got a special opportunity for you. If you go to Mises.org/RR raffle, that's double R, raffle, you can enter in to get a free admission to this very special conference. Also, if you're a student, we've got scholarships available for you at the event site, Mises.org/events. So I hope to see you guys there, and now enjoy the rest of the show.
Welcome back to Radio Rothbard. This is Ryan McMaken. I'm editor with the Mises Institute, and with me, of course, is my co-host, Tho Bishop. And this week we have a guest. Our guest is Doug French. Now, if you've been reading Mises.org for any period of time at all, you know that Doug is one of our regular contributors. He's also president emeritus of the Mises Institute, author of 2 books, Early Speculative Bubbles and Increases in the Money Supply, and author of Walk Away, The Rise and Fall of the Homeownership Myth. And both of these, you can come on Mises.org and link to those, and we make them available to you. And by the way, Doug received his master's degree in economics at UNLV under Murray Rothbard and Hans Hermann Hoppe. So this guy's well-versed in Austrian economics, also the issue of booms and busts, speculative bubbles. And this is a guy who knows stuff about the real estate market. Also, his background is in banking and mortgage banking, and he's lived through a couple of cycles, at least 2 of these as well, the Great Recession, the current cycle. And so we were having him on because we want to talk about real estate right now. We want to talk about commercial real estate, which looks like it's going to be an important issue in the current cycle. Now, he's got 2 recent articles that I think I'm going to be drawn upon for this. And one is on Mises Wire called "The Fed Claims the Banking System is Sound and Resilient. The bank's balance sheets say otherwise." And that's from a few days ago here on The Wire. And then another one from Power Market on how CRE maturities are piling up and how that's an issue for banks. So, Doug, can you give us the basics of what's going on in commercial real estate right now? Why is this something we should keep an eye on, and why this is something that is going to be important in the next cycle?
Well, what we have is commercial real estate due to 2 factors primarily. But number one, the increase in interest rates. During the Fed experiment of zero interest rates, that attracted real estate developers and real estate investors to borrow money at incredibly low rates, 3%, 4%. And in some cases, they borrowed this money at fluctuating rates. In other words, they weren't fixed. They got as low as rate as they could. When you have low rates, you have what's known as low capitalization rates or cap rates. You hear that term thrown around. The cap rate is, think of it as, for people who are familiar with stocks, that is the kind of the inverse of a PE ratio. If a stock is trading at 20 PE, the real estate term for that would be a 5% cap rate. 25% PE would be a 4% cap rate. And that's how buildings, commercial buildings, are valued based on a cap rate. So right now you might even have tenants that are paying their bills on time, and yet if the bank or their internal or external regulators come in and say, hey, get a new appraisal on this, we think your loans and not covered by collateral properly. If that rate fell from, say, they lent it, assuming a 4% cap rate for the value, and the new appraisal comes in at a 5% cap rate, which could easily happen, that's a 20% fall in value. And if you made an 80% loan, which probably that would be a little aggressive, but if you made a 70, 75% loan, suddenly you're very close to being underwater. Now, to the other issue is that during the COVID years, people were allowed to work from home, told to work from home. Dr. Fauci told us all to hunker down, shelter in place. And guess what? Nobody wanted to come back. So you have office buildings in New York, you have office buildings in other LA, San Francisco, other areas where you've got tenants that, they may be still paying the lease, but they don't have anybody showing up to work. So when those leases roll off, they're not going to take that lease, that space anymore. And these buildings are going to be in serious trouble. And it doesn't quite happen like a stock market crash. Real estate takes time because the loans don't come due right away. But my point of the piece that was on the blog was that suddenly we have nearly $1 billion of loans maturing this year. And when those loans come due, the bank goes out and gets a new appraisal on that property. They're not going to have near as much collateral as they did before. And what they'll do is they'll ask the developer, who doesn't know how to spell cash, to come in with more cash to go ahead and extend that loan, probably at a higher interest rate that will not, their leases may not cover. And you'll have people walking away from buildings. Big real estate operators like Brookfield, Blackstone, they've already walked away from properties. And this is going to play out over the next 2 to 3 years.
Well, and office vacancy, of course, is when things turn even a little bit sour, you can start to see some pretty huge vacancies there, even in previous cycles, even when people actually went to offices to work. But of course, this seems to be on a whole new level where even with economic improvement, you didn't see a resurgence in demand for office space. But is this beyond office also? Where are we when we're looking at strip malls, retail, those sorts of commercial properties?
I would contend that even though strip malls, even though multifamily does not get mentioned in the same breath with office buildings, that the same issue with interest rates is going to plague these properties as well. There were plenty of properties in my hometown here of Las Vegas. Properties were purchased in the multifamily at 4% caps, even in the 3% cap range, with the idea that they would be able to raise rents and make the project work. And plus they had low interest rate loans. So those loans that they were paying 4% on 2 years ago, 3 years ago, now they're having to re-up those loans at 7, 8, maybe higher. And the project just won't work at that point. And these are not all bank loans. The big banks are certainly not exposed to this, but the smaller banks and the regional banks are very much exposed to these big real estate projects, small real estate projects, because they don't have anything else to lend on. If you're Jamie Dimon at JP Morgan, you can issue credit cards. You can make car loans real cheap. You've got the infrastructure to do that. But if you're a local community bank, if you're a regional bank, you load up on real estate because that's the only game in town.
Yeah, that's an important distinction to be made also, right? Is a lot of what we're talking about the groups that are in deep trouble, it's not these huge banks. It tends to be overwhelmingly these more local and regional community banks. And from what I've seen over the years, it's those that start to feel the pain fastest from defaulting businesses, from local commercial real estate, because they just don't have access to these larger portfolios where they've just got so many income streams when you're JP Morgan that it's just a totally different ballgame for these small local banks, right?
Exactly. And as when Silicon Valley Bank failed and Signature Bank failed, where did all those depositor runs? They ran to JP Morgan. And JP Morgan will give you virtually nothing on your money. Whereas the smaller banks, the regional banks, if you look at CD rates, they're having to pay up to try to draw some of that money out of the Fed funds or out of the money market. And so that puts even a tighter squeeze on the smaller and regional banks. Jamie doesn't have that problem. Jamie can sit back and wait for the next failure, whether it's going to be New York Community Bank, which, by the way, is not a community bank. They call themselves a community bank. They absorbed a lot of the assets from Signature. They probably wish they didn't. That was the focus of the article that we led the discussion with. They inherited all this multifamily, this rent control apartments in New York, and some other office type properties that I think it was the OCC that made them write them down at the end of the year. Imagine banks at the end of the year, the last thing bankers want to do is take a write-off like that, because number one, they had to show a loss for the quarter. Number two, they had to cut their dividend, and number three, you can imagine some people got fired and some people didn't get bonuses, and that's the name of the game. It's the last thing. When I emphasize the word begrudgingly take those reserves, I mean it. I've been there. And believe me, banks are going to be very slow around the country to make these adjustments to their reserves or take these losses or order new appraisals. They're going to have to be goaded either by the regulators or possibly by the stock market. The stock market will be a good tell on this. If you watch the CRE or KRE, ETF for regional banks, it's done nothing but go down, and it's going to be a good tell as to the health of the regional banking.
And of course, we've seen a consolidation of the banking industry. I mean, Dodd-Frank, with all the new rules and regulations that came with that as a response of 2008, 2009. We got gigantic bills, which only amplified with all the rule writing provisions within that, has led to consolidation. These risks, these stresses that are piling up now, and of course, we're still dealing with some of the protection plans kind of from that response to Silicon Valley Bank. Some of which are expiring, I believe, next month. And so, the Fed is, a lot of the tension has kind of gone away from the pressures that led to Silicon Valley Bank's demise. But all this is leading to a gradual consolidation of the banking industry, which, particularly from our perspective, the dangers of the relationship between the feds and bigger banks, the willingness of them doing all sorts of spooky things that we don't like, creates non-economic concerns out there. But are you concerned about kind of this gradual pattern of consolidation, which is seeming to be amplified by some of these underlying stresses?
Well, it's inevitable. When I started in banking, which is a long, long time ago, say 1986, when I moved to Vegas, happened to be the same year that Murray Rothbard moved to Vegas and Hans Hoppe moved to Vegas. But when I started, there was probably 15,000 banks in the country. Now we're down to 4,000. So you're going to have a continual consolidation. Now, some of these people, there are people that are trying to make the case that this will happen. The market will happen, that banks will hook up and not be forced to by the FDIC or other regulators. But I would contend that will not happen very often. And the reason is that most of these banks, when interest rates were, and again, this goes back to the Fed's policy of zero interest rates, when they had all these deposits rolling into their banks during the COVID years and the fire hose of fiscal policy that went into bank accounts. People put money in the bank. What were the banks going to do? They didn't have loans to make. What they did was they bought treasury securities at less than 1%, 1%, whatever it was. And now they have unrealized losses in the billions as an industry. Well, those unrealized losses, they can keep them on their books that way, as long as they call them held to maturity. But the minute the two banks try to merge, those unrealized losses become realized losses. So it is very unlikely that you will have a lot of bank mergers to consolidate. What you're going to have is you're going to have failures that are going to be tipped over by real estate one way or the other. The Fed will be the match, or the FDIC will be the matchmaker over a weekend. And they either find Jamie Dimon, or if they feel like Jamie's got enough or too much, then they'll find other banks to buy up, take over the deposits, and essentially the shell game continues.
Well, and I mean, just to make it clear for the more casual listeners on the issue, right? When you're talking about these small banks avoiding defaults and being able to pay their loan payments to make their debt service, we should be clear, right, that banks are not sitting upon these piles of money somewhere, right? And when you talk about how, okay, they're required to increase a loan loss reserve and take steps to avoid a bank failure situation, they have to take that money away from where it's been employed in other places, right? These banks, they don't have like extra cash lying around. And that seems relevant also to the issue of where, okay, so as interest rates go up, they're going to have to pay more for that debt service, which I guess if the economy was good, they could just raise rents. But they can't do that now, right, is what I suspect, is that you're going to your strip mall and you're saying, hey, we're going to raise everybody's rents. That's just going to increase defaults, right? And so now they've just got no income on those units instead of insufficient income, as had been the case.
Absolutely. More and more we hear about customers availing themselves of buy now and pay later. Well, what's that do to to the strip mall occupant. How do they? What do they pay? How do they pay their rent on a promise from various customers? And so, no, banks, folks, for those listening who believe that banks are keeping their $1,000 deposit somewhere lying around in the vault, waiting for them to show up. That's just plain not true. They took that $1,000 and they lent it out to somebody. They lent it out likely to a real estate developer in some cases that may pay it back. Maybe he's got a year maturity, maybe a 2-year maturity, and maybe can pay it back if the project works out. Except the depositor can come and get that money any day. So you've got this mismatch of where the money goes, the assets that are lent on, and what depositors can do. They can come and get the money anytime. And that's what happened in the case of Silicon Valley Bank. All it took in that case was some high power. They had an incredible amount of uninsured deposits. That's deposits over $250,000. And they had a lot of Silicon Valley. Some of them were on a ski trip, and they just moved their money over to Jamie Dimon's JP Morgan Chase while they were heading to the ski slopes. And so you had a 48-hour run, and they were done. That's all it took. This was a huge bank, second largest banking failure in the United States. If you ask the normal person, they don't even know anything about SVB and that failure last year. And if you said, "Oh, well, was that one of the biggest failures in U.S. banking?" "Oh, I don't know. That was just a small bank." So they continually try to poo-poo this idea that these are large banks, and it goes back to Tho's point that the industry is consolidating. So whenever you do have a failure, now occasionally you can have that failure out in Ulysses, Kansas that happened a few months ago, or the one in Iowa, or whatever the case may be. But you get anything that hits the radar at all, these are very, very sizable financial institutions.
Well, I think there's an interesting dynamic there as well, where the risk of bank runs with modern technology, and you kind of alluded to it with the ability to be out skiing and be able to kind of effortlessly move your money to a larger bank at the prospects of issues going on with your institution. The ECB was warning about the impact of social media on bank runs. Social media was blamed by a lot of DC regulators in the aftermath of Silicon Valley. I think the dynamic there of, I could see increasing calls for censorship of bad economic data going forward from a variety of angles that feeds into a lot of the authoritarian ideals of a lot of the people in charge right now. But that speed with a banking system that already has if there's any break of trust, this entire framework of the fractional reserve banking system that we have right now in this technological, very quick windows of concerns and things like that. I mean, that's something that, regulators are not necessarily known for their speed with these sort of things. Though we saw some of the Silicon Valley Bank being able to handle it in kind of back rooms over the weekend. But that is an additional pressure to all these underlying issues with balance sheets. Definitely adds an interesting twist to the current banking environment.
I wrote a piece recently. Will fractionalized banking survive the 21st century? And that's essentially what that was all about. But the regulators, you're right. I mean, they're not one step behind. They're miles behind. They're still fighting the 2008 war. Mm-hmm. And that's why when now that we have another real estate problem, this is right in their wheelhouse. So they're going to be sniffing around. looking to downgrade loans, and they think that's where the problem is. But probably the bigger problem, as Tho points out, is that people can move their money with their phone, on their laptop, on their PC, with the click of a mouse. I think Rothbard would be he'd be cheering this on, frankly, and I don't think he could probably hardly believe it that you could do this. No more lining up. He'd say, yeah, we don't have to line up anymore. We can just, click our mouse and, start a bank run. That's great.
Well, I'm sure, Doug, you have your finger on the pulse of the bankers on the ground and like the human beings we call bankers. And this level always interests me, just how bankers view things. And it just reminds me of how in 2007, we managed, he was in town, he was in Denver. So we managed to get a very short meeting with Angelo Mazzillo and just said, who is head of Countrywide Bank. It's a huge mortgage bank. And
Sure.
We knew in our state that we had a foreclosure problem. They were really mounting. People were getting evicted, all of that sort of thing. So we said, Angelo, right, you know that like you've got a lot of foreclosures piling up here in Colorado. And he had no idea. And he was completely unaware. He managed to bring in some underlings who, when he asked them, oh, do we have a lot of foreclosure? They're like, yes, we do. But, it's a small part of the portfolio. Didn't feel the need to mention it to you, that sort of thing. So the bankers are way behind on just the kind of recognizing there was a problem back then. I mean, where are bankers now in terms of just their view of the issue?
Well, I think they're where we were back in, 06, 05, 06. And I got this question the other day because if you live in Vegas, there's a lot going on here. There's 115 people a day moving here. Obviously, some homes are being built and so on and so forth. And they go, oh, all this development, gosh. And I said, you know what? Last year, there were like 8,000 new homes built here. And they go, wow, that's a lot. I said, think about 2006. There was 36,000 new homes built in Las Vegas. 36,000. We'll probably never see that again. The problem is when you're on the inside, and I was on the inside looking out, not on the outside looking in, but when your livelihood depends on making that next loan and or if you're a developer building that next subdivision, you just don't think it's ever going to you're going to end. And Mazzillo's I remember one of his lieutenants came and spoke at a marketing meeting that I used to attend when I was a banker, and this guy pounded the lectern saying the biggest impediment to home ownership in the United States is the down payment. We have to get rid of the down payment. And it's just hysterical to think about now. But everybody was, a room full of primarily real estate agents were nodding their head, in unison, thinking, yeah, if we could just get away from the idea that people have to actually make a down payment on a purchase, then all would be right with the housing market. And now today, what we see, the housing market is kind of dead in a way. I work at a shop where we have a mortgage arm. We made one mortgage loan last year, I think. Everybody's got to, if they own a home, they've got a, 4% mortgage or 3.5% mortgage or whatever, and they're not going anywhere. Very few of these loans are VA loans or FHA loans that allow for an extension or an assumption, I mean. And even if even if you do try to sell your home and the buyer tries to assume your loan, it takes months and months and months to try to do it because you're dealing with some kind of FHA or VA bureaucracy. So, that has really gummed up the housing market. So we have a different, certainly a different dynamic going in housing right now than we had back then. And the issue now is with commercial, which, there's parts of the country that are still very small, strong as far as commercial real estate, but again, that naughty thing called higher interest rates. These are actually normal interest rates. Right. There's nothing. People act like this was like Paul Volcker showed up, and the prime is 20%. This is idiotic. These are actually normal interest rates. But if you run into a developer, he'll just go crazy with these incredibly high interest rates. Not incredibly high at all, and I don't. Rates are probably going to stay this way for quite a while.
Right, and you don't have to be elderly to remember interest rates at 5 or 6%. You just have to remember the late 1990s. So
No, I remember builders when I was in the business that were buying down rates for purchases in their subdivision. They were buying down rates to 7 or buying down rates to 6.99 so they could put an ad in the paper to attract people to their subdivision. So this idea that 6% mortgage rates or 7% mortgage rates just keeps everyone out of the housing market. I suppose it does make it tough for younger people. Probably Tho wants to jump in here, but for us old folks, these are kind of normal rates. If you could go out and get a 7% mortgage, but it does make it tough for the next generation. I agree, and as more and more debt gets piled on in every place, from the federal government at $33 trillion to corporate debt to now private debt through various firms. Just debt has run rampant, and the higher it goes, the more people are going to pay the price and not be able
and
to
it seems
pay.
also part of the problem for young people, first-time homebuyers and such, is also the fact that in a normal market, prices would go inverse to interest rates, and prices would go down as interest rates went up. But the market's frozen due to a variety of factors, and the prices aren't going down, so you're just screwed on both price and the interest rate now.
Well, and particularly here in Florida, where I'm at, we've seen prices continue to go up, and I think one aspect of that is kind of the financialization of housing with the Airbnb market, where you have investors coming in to neighborhoods and buying up properties that might historically have been rental properties. I'm in a service industry town. You went from having 4 waiters renting a 3-bedroom house or 4-bedroom house to being purchased from someone outside the state, being able to turn into rental properties. I know that's creating a lot of tension here. But yeah, so you have that dynamic where again, younger people. I've been talking to friends for years. Took me for a while to finally get the courage to actually buy a house because I kept waiting for prices to go down. I'm very glad I did in 2019. I would not be able to afford the house that I have right now if I had waited there. But there was this continuing expectations among people my age that I'm just going to wait it out. Now, if they've missed that period of low rates, now they're really really feeling anxious. And I feel like going into this year, right, the assumption was, the Fed's going to lower rates. That was the expectation. Now there's increasing interest rate concerns out there. The Fed, seems to be, they were indicating a pivot at the end of the year. Now, there seems less certain about that. So again, trying to guess what the Fed's going to do, particularly when the Fed's own track record of their own interest rate policies has not been great, as Jonathan Newman does a great job of illustrating every few months on Mises Wire. You try to play that game of guessing the future of the Fed, leaving a lot of people quite upset right now.
Yeah, there's no question. I used to get, when I was, had the job down in Auburn, people used to ask me, young people, should I buy a house? And I would always say, are you married? Say, yeah. And I said, if your wife wants a house, just buy a house. Don't try to time it one way or the other. Just make her happy, because and because if you have a higher rate, if you can qualify at 7% right now, getting a deal, and because I mentioned this in an article I wrote recently. I think there's three strands to a home purchase. You're betting on the land, and land tends to go up in value because dollars become worth less over time. So land tends to go up if you're in a growth market. You consume the house. It's like a big refrigerator, and you're short the bond market. And if you're short at a high rate, I mean, it's even better, because every mortgage you get, you're allowed to pay it off early and refinance. And plus, you get to write off the interest, especially if you're a younger person. You don't make that much money, it still qualifies as a tax write-off. They've done everything they can to make, everything but point arrows at houses to tell people, buy a house. But I still know people that they're waiting for the big crash, the real big one, where houses go to zero, I assume. But it's just not going to happen. I mean, and in some states you can walk away. Somebody I know wrote a certain book about that. But yeah, it's owning a home is 9 times out of 10 in history. It's been a because it's so rigged by the government for you to do well.
Well, let's look at that rigging a little bit as kind of we wrap up here. You mentioned in your recent article on bank portfolios from Wire, you note that the bank term funding program is going to be phased out next month. This is just part of what we're seeing here in the central bank's effort to just keep all this liquidity sloshing around in the banking sector, just as an effort to keep the party going. They don't want to take away that punch bowl. And so the bank term funding program was part of that. And this just leads us to the question of, well, why not just lower interest rates then? Why are they phasing out the bank term funding program? It seems that, right, we need the Fed to keep things going, but the Fed just refuses to lower interest rates. The Fed is taking some liquidity out of the sector. I encounter a lot of industry people, even usually guys who are a little less seasoned. Well, why doesn't the Fed just lower interest rates and then things will be fine again? Now, something that I note is that, well, inflation is a political problem, and it's not just strictly a matter of bean counting at the Fed. But I mean, what are they thinking at the central bank? Why not just fix it with lower interest rates and easy money again?
Well, I guess that implies that the idea that Jay Powell could open one of the windows at the Eccles building and lean out and just shout, "We're lowering rates." But what they have to do to lower rates, of course, is create they are going to issue $1 trillion in Treasury debt this year. And so the idea of lowering rates, just if they're not going to get into the be in the system, if they believe that if Powell believes himself to be the next Paul Volcker and does not want himself to be seen as the Arthur Burns II, then he's going to let quantitative tightening continue, probably leave rates the same. And the Treasury is going to issue bonds, and rates with all that issuance are likely to tick up, probably not tick down. Now, as far as the bank term funding program, which if anybody listening to this program thought that was some well thought out piece of Fed machinery that they considered for months before doing, think again. It happened over a weekend when Silicon Valley Bank, hit the ditch, and they suddenly created this thing out of nowhere, and now it's hit an all-time high, I believe, in borrowings against it. And what it allows banks to do is lend against their security portfolios at par. And that's important because most of their security portfolios, as I mentioned earlier in this, is that they're underwater. Their bonds in a 5% market are not worth as much as bonds when they bought them at a 1% market. They've gone down 20, 30, 40%. But the Fed has allowed them to borrow at par. Now, if they're going to stop this on March 11th, that means they've got to direct people in trouble somewhere else. And that may be some other Fed program that they either create or they already have in place. But believe me, the Fed's job, they talk about sound currency, which is laughable, full employment, probably laughable again too, but no, their real job is to backstop the banking industry. And when I say backstop the banking industry, I really mean Jamie Dimon and the rest of his buddies in that, rarefied air of, 5, 6, 7, 10 banks, whatever it is. Beyond that, they're going to let some of the small fry, go. And so I don't know what they're going to do. They're going to have to do something. That banks are able to borrow against that up until March 11th. But does that mean they have to? Okay, it's going away. Does that mean they have to pay it off? I doubt it. They'll probably let it roll off over time. People who need to borrow have to go to another facility. But I would be on the lookout. Your listeners should be on the lookout for new programs to be created, or possibly a last-second extension of this program. That's what happened with TARP. TARP turned into a more of a permanent funding program. There's a lot of people, a lot of banks, I say people, a lot of bankers, a lot of banks that couldn't pay off their TARP loans back in the 08, 09, 10. They couldn't pay those off. They created another program to let them term it out over time. And I would expect that that's what we would see. But there's going to be more issues in the banking sector. Don't look for it next week. Maybe it'll be a month. Maybe it'll be a year, 2 years, 3 years. This is going to be a slow motion train wreck. But there's just no doubt. And combined with the issues we've talked about with people with technology and young people, they don't care if their father banked at the bank down the street. They don't care. they're just going to wherever, who's got the neatest app and that sort of thing. So there's no loyalty to any particular bank anymore, and that's all pretty good. But we're gonna, one thing that'll never go away, as much technology as they can throw at it, problems with fractionalized banking will never go away because it's inherently fraudulent.
And of course, one way I know that they've been discussing as a replacement, for that lending portal is to try to destigmatize the discount window.
Yes.
Which is kind of, in theory, supposed to be used for emergency banks or for times of emergency. They're trying to force large banks to tap into that, a few times a year just to kind of make it seem normal for everyone else. And so, here we have the Fed trying to normalize emergency programs for the banking sector as a whole. And again, it's just humorous that they are taking these steps while assuring the public that, and you mentioned this in your recent article in The Wire, that the Fed claims the banking system is sound and resilient. Everything they're doing outside of their public statements says otherwise. The economy is great, but we have to put in these protections for banks right now. Of course, this entire policy of kind of gaslighting the public to not see what is happening behind the scenes is the kind of the main tool that the Fed has right now. Generally, but they're trying to normalize these emergency programs to become part of the day-to-day operations of some of these institutions.
Yeah, this idea of banks going to the discount window, I can tell you from experience that would, if you ever had to go to the discount window, I mean, you would be painting a target on your back, essentially. And so that's why bankers would never, ever want to go to the discount window. And as you say, though, they're trying to now normalize that. Oh, yeah, big banks, we want them to use the discount window. There's even talk of having them store reserves with the Fed. You talk about consolidation. Pretty soon you won't have a local bank on the street. We'll have one bank in the United States, and it'll be called the Federal Reserve Bank. And that's, that'd be it if banks were forced to just put reserves at the bank, just in case they, should need them in the future. So.
All right. Well, we'll go ahead and wrap up with that one. This is an evolving situation, you might say, and things could look very different just a few months from now. And so, Doug, we'll have to have you back when there's some new developments in this situation, because, I do think the real estate, whether commercial, whether residential, because so many people are tied up in it. And so many local banks are tied up in it. That it's such a major part of the portfolio that, I think it really continues to be just an important bellwether for the larger economy overall. So thank you for joining us today, Doug. And if you're not familiar with it, make sure and check out his articles. He has a lot of articles both on The Wire and on Power and Market. He's got his own website, douglasinvegas.com, which I mostly lift. Most of that Power Market content I take straight from his site a lot of the time. The only time I really don't run his stuff is when it's highly topical and I miss the window for it to be timely. But for the most part, right, it's all great stuff. So check it out.
Well, you can only have so much Taylor Swift stuff.
And a lot of great stuff on gambling as well, which I always appreciate your articles on.
If I could make one more comment, just that I've got the 4th expanded edition of Early Speculative Bubbles and Increases in the Supply of Money coming out March 5th. This is a book that started as my thesis that I wrote under the direction of Murray Rothbard. Hans Hoppe was on my thesis committee. And what I've added is a presentation I made at last year's AERC on the Panic of 1857. So you've got an Austrian look at Tulip Mania, the Mississippi Bubble, South Sea Bubble, and now the Panic of 1857. And like a box of Cracker Jacks, there is a surprise inside. Not everybody can put the signature page from their original thesis in the front matter. So the top signature is a guy you'll recognize, as is the second signature. So anyway, March 5th, I know I've talked to Brandon Hill in Mises bookstore, and he's going to have some copies for upcoming events. And so eventually, I think, hopefully, we're going to have that fourth edition in the store. So I appreciate that shameless plug.
Well, and there's also a link to the pre-purchase link at the end of his Power Market articles. I know that as well. So you can go right through on that if you so desire. So thank you for joining us on this episode of Radio Rothbard. And we will be back next week with another episode, and we'll see you next time.